Hello everyone, welcome back to another video. Today we're going to be covering asset-based lending. Now, asset-based lending are loans made to businesses backed by a liquid asset used as collateral for the loan. Businesses that use ABLs are either highly leveraged or too small to take on more bank debt and must resort to alternative lending solutions. These loans are used to increase the working capital of a business in order to help finance growth or operating activities. Now, some common industries that use ABLs are the steel, retail, and transportation industries. And the reason is they are very cyclical businesses. When the economy is performing very well, inventory is low, and the length of accounts receivable outstanding, the days outstanding for these credit accounts, are much shorter. Whereas when the economy is performing poorly, inventory stocks up, accounts receivable, the length outstanding, the days outstanding extends and increases, and therefore the business is limited from a cash perspective, from a working capital perspective. Now, it's important to define what working capital is. Working capital is the capital a business uses in its day-to-day operations, calculated as current assets minus current liabilities. Now, a common problem is that some businesses face working capital restrictions, which essentially means that they don't have enough cash to support their day-to-day business. If they sell products and services to customers on credit, meaning that there is an account receivable, they will be waiting for that cash to come in. Or if that business has a lot of inventory, it needs to sell this product first before it can actually receive the cash used to pay employees, used to pay the bills to support that business. And this is a real problem. So this is not a long-term loan. ABLs are not used to finance long-term operations. Essentially, they're used to support the day-to-day operations and are closed out usually within a 12-month period. Now, what are the key drivers of asset-based lending? Well, asset-based loans can be categorized into 4 different segments. There can be performance drivers, which essentially means the industry is performing very poorly, and therefore that business needs more financing to support their working capital. There can be growth drivers, which essentially means the business is growing. It's growing very, very fast, and it's actually exceeding its ability to finance its own growth, and therefore the company seeks additional financing in order to support that additional growth, whether it's through working capital needs or capital expenditure needs. It can also be expansion through M&A and capital market drivers, which essentially means paying stock dividends, actual dividends, or it can actually refinance different upcoming debt maturities. So there are a lot of drivers behind asset-based lending. It's not just that the business needs cash. So there are a lot of strategic considerations when it comes to the lender and how they view the borrower. And so we'll go into that. So what ABLs offer is a way to finance the business's day-to-day needs by taking out a loan on these accounts receivable or inventory, which allows owners to pay for expenses while the receivables are collected or inventory is sold off. There are 3 common ABL structures. There's the recourse and non-recourse financing structure, there's the purchase order financing structure, and the inventory financing structure. And so we'll go into each of these. So recourse and non-recourse financing. Before we actually understand how an ABL is structured, let's actually define what a recourse loan is. A recourse loan is where the lender is able to seek financial damages to be paid back in full if the borrower defaults on their loan. The liability is on the borrower, as they have to find a way to pay back the loan in full. So even if the value of the loan's collateral declines, the lender can ask for more assets in order to be paid back in full. So a loan can either be recourse or non-recourse. With a recourse loan, if you default, even the collateral that you put up against that loan, if it does not cover the financial liability, the amount that you have to pay back to the lender can then go and ask for more assets in order to be paid back in full. Now, a non-recourse loan is where the loan is secured by collateral. However, if the borrower defaults, the issuer can seize the collateral but cannot seek out the borrower for further compensation. So the liability is on the lender, as they would lose money if the collateral does not make up the entire value of the financial liability. So with regards to ABLs, a recourse financing agreement would advance funds up to 90% of eligible receivables, which essentially are within 90 days or less. And then once that account receivable has been collected, the lenders pay back the difference, net a fee for the service. In a non-recourse agreement, because the lender is taking on more risk, because essentially if the business is only putting up their account receivable as collateral, if that account receivable doesn't go through, the borrower can just default on that loan, and the lender only has the account receivable as collateral. They cannot collect on anything else. So in a non-recourse agreement, because the lender is taking on more risk, the advance is between 70 and 80%. So it's less than a recourse financing agreement for the same eligible receivables value. So once the account receivable has collected, the lender pays back the difference, net a much higher fee. So there are higher fees for recourse agreements in order to compensate for that risk, of course. So let's actually go into an example. So consider a company that has a $1,000 account receivable. The lender charges a 5% fee for the recourse agreement, while they charge a 15% fee for a non-recourse agreement based on advance funds. So with a recourse financing structure, the average is around 90%, as we said, in advance. So we take that and we finance. So this is a recourse financing agreement. We give that account receivable directly to the lender. And so from now on, the customer that needs to pay that account receivable will pay directly to the lender instead of us. So that $1,000, 90% of that is advanced to us. So we receive $900 today. 20 days later, when the customer finally pays back that bill, the lender will calculate their fee based on the advance value, so $900 times 5%, which is $45. So the remaining $100, they deduct a $45 fee, and the remaining amount of $55 is given back to us. So we receive a certain amount of that today, and then we receive a little rebate at the end, net of fees. So with a non-recourse, you'll see that the fees are larger. So in this case, the advance is less, percentage-wise, 70%. So we receive only $700, and that could be, of course, because the account receivable was risky, or that's just the way we pursue it. And so 20 days later, the customer pays back the account receivable, and so a fee is charged on that $700 of 15%. So the fee is $105. So the $300, that was the difference between what we receive now and what we will receive later. $105 is deducted away, and we receive $195 20 days later once the account receivable has been paid in full. So that's how the recourse and non-recourse financing agreements work. Okay? Now, purchase order financing. In a scenario where the company has received a large order and does not have enough cash available to cover the cost of production, it can pursue the purchase order financing option. This allows businesses to use their confirmed customer backlog and invoices to get an advance on their credit in order to increase working capital. So the borrower accepts the invoice for the sale of their good or service and passes it along to the lender, who collects on the invoice. In return, a certain percentage of the sale is advanced to the borrower. Once the sale is completed and the payment is received by the lender, the difference between the advance and the sale price is returned net of fees. So really, it's quite similar. So in this case, we have an account receivable as well. We have a backlog. But the thing is, here, we need money in order to fulfill that backlog, in order to complete that production, that producing those goods in order to complete that sale. So what we do is we go to the lender to get the necessary money in order to complete that sale. Whereas with the recourse and non-recourse financing agreement, the sale has already been completed and we're just waiting for payment from the customer. So that's the difference between purchase order and recourse and non-recourse financing. Okay? So the advance is dependent, and this is key, on the certainty of payment by the customer, not the borrower. So really, when the lender is looking at that backlog, they're analyzing, will the customers back out and not really pay the full fee, or will not be able to pay that, or will they be able? So there's a lot more focus on the customer rather than the borrower in the purchase order financing agreement. With the account receivable, it's much more balanced, because at the same time, with recourse and non-recourse financing, you have to analyze the borrower's accounts receivable management strategy, and at the same time, still the customer who will be paying that account receivable. So the focus is much more split with recourse and non-recourse, whereas with purchase order, it's much more emphasized on the customer. So a safe customer could result in a 90% advance, while a riskier one could mean an advance of 70 to 80% of the order backlog value. Now let's look at an example. Having recently bought out one of my partners or one of his partners, the business has only $1,000 in cash. So their working capital is $1,000. There was a recent request, a recent order for $10,000 worth of chairs. The cost of production with the labor and materials is $9,000. The owner decides to pursue a purchase order agreement, which charges fees of 7% on the advanced funds. So in this case, because it's considered a safe customer who is able to fulfill that payment of that sale, the advance is 90% of the backlog value. So in this case, it's $10,000 times 90%. So we receive today, as the business owner, $9,000. Now, 6 weeks later, we complete the production of the chairs and complete the sale, and the customer pays. So when that payment goes through, which goes directly to the lender, not us, because now they have that account receivable, there is a fee of 7% deducted from the $9,000 of $630. And so the difference between what was advanced and what was the actual sale of $10,000, which is $1,000, we subtract the fees from that difference, and the net result of $370 is given back to us after 6 weeks. That's how a purchase order looks. Finally, inventory financing. Now, inventory financing is a form of ABL where a business can leverage its inventory. Inventory financing is especially useful for businesses that must pay their suppliers in a shorter period of time than it takes them to sell their inventory to customers. It also provides a solution for seasonal fluctuations in cash flows and can help a business achieve a higher sales volume, for example, by allowing a business to acquire extra inventory to sell during the holiday season. And so let's look at the processes first, and then I'll actually explain these benefits. So funds are drawn from inventory as it accumulates, which is the value of that inventory, and are paid then back once inventory is sold off as a finished product to clients. So as inventory builds up, our line of credit, the amount of funds available that we can really draw on inventory financing, increases. Now, usually inventory financing is used in combination with an invoice factoring facility. And so when we begin to sell that inventory, we have to pay down the amount that we took out, that line of credit. As we sell, that money goes to pay down that line of credit right away. So there's a lot of limitations in that sense. So there's a lot of priorities. So the priority is to pay down the line of credit before we can actually go to paying our bills. Okay? Now, with the invoice factoring facility, this means that once a sale of inventory is complete, that invoice is received and is financed through a factoring line, and the proceeds are used right away to close the corresponding inventory line of credit. From that point on, the transaction is a factoring transaction where the customer pays their bill on schedule and the borrower is rebated the remaining amount. So I won't spend too much time on that. You can actually look that up separately, invoice factoring. But essentially, when invoice factoring is the business has the ability to take an invoice, give it to a lender, and tell them, okay, advance us the amount that we should be receiving from our client, net fees, of course. And once the client pays that money back in full, we receive the remaining amount net of fees. Okay, so it's similar to what we've already talked about with recourse and non-recourse financing. And I think an example would be better. Now, the advance is usually 80% of the inventory's net orderly liquidation value or the forced sale liquidation value. And these are lower than market value and sometimes even substantially lower. So that's one of the downsides to it. Now, consider a situation where the days inventory outstanding, the DIO ratio, which is the average number of days that it takes to sell inventory, is 50 days. If we have $100,000 in inventory and have a bill of $80,000 due in 20 days, we won't have enough time to sell that inventory because it'll take 50 days to sell all of our inventory to pay a bill in 20 days. And so this is an ideal situation where inventory financing can be used. So if I have $100,000, which is the liquidation value, by the way, and I have that $80,000 bill, I can finance my inventory. And so usually it's about 80% of the net orderly liquidation value. So 80% of $100,000 is $80,000. And we can take that money right away and pay the bill in 20 days when we need to. Now, let us assume that I sell the inventory for $120,000, which is the market value of that inventory, and expect to be paid in 4 equal installments. So the way the process works is I receive that advance on the inventory. The inventory still remains with me. The lender doesn't receive that inventory. What I have to do is sell that inventory, and as I sell it and realize the monetary value, the cash value of that inventory, I then begin to pay down my debt. So in a very, very easy example, if I were to sell all of this inventory for $120,000, I then take that invoice which I received from the customer, who will pay me in 4 equal installments. I now then factor that invoice. We talked about that. This is the invoice factoring facility. So taking the invoice, I put it into the invoice factoring facility. So I receive the customer invoice, which is financed through the factoring line. And usually the lender finances 80 to 90% of that value. So assuming 80% of that $120,000 that we should receive from the client is $96,000. I take that money, which I now have up front. I can then pay the advance that I received from the line of credit for my inventory. And from then on, so now I use this to pay down the inventory line of credit plus fees, and then wait for the client to pay the invoice, which the lender collects on. Once the $120,000 is paid in full and received by the lender, the difference of $24,000, which is the difference between $120,000 and $96,000, would be rebated less more fees for the invoice factoring service. So it seems confusing, and this is why, if you've done any additional research, many people say inventory financing should be your last alternative when considering other ABL options, because this joint double fee system can become very, very costly. So once again, let me explain it. I have inventory of $100,000. I need to pay a bill in 20 days for $80,000. So I receive an advance of $80,000 to pay the bill. Now, if I were to sell that inventory for $120,000, I now have an account receivable of $120,000. I don't receive the cash right away. Majority of the industries, you'll have on account. You'll receive that on account, on an account receivable, and you will have to wait for that customer to pay you back. In this case, 4 times for the full $120,000 amount. So what I can do in order to quickly pay down that line of credit is factor that invoice. So I receive an advance of $96,000, which is 80% of that invoice. And I take that money, net of fees, and pay down the line of credit of $80,000. Now, the account receivable is actually on the inventory line, right? So now, essentially, I wait for the customer to pay back the full amount, to pay me the full amount, essentially, which is received by the lender. And once the lender deducts their fees, I am rebated a certain amount of that $24,000 difference. That's inventory financing. It's a little confusing. If you have any questions, please do comment below. But as you can see, it's very complicated and can become very costly. So as you can see, the inventory financing option can be costly. You will pay several different fee charges, and with different interest rates ranging between 4 to 6% plus the prime rate, it can be very, very costly. Another consideration is the cost of holding that inventory. So that inventory is not just going to stay at home. You're going to have to put it in a warehouse. You're going to have to take care of it, security, electricity for the warehouse, everything. So how much would it cost to wait and sell off the inventory in order to pay down that line of credit? So among the 3 options presented, inventory financing is usually the least favorable, because sometimes the only ABL option available for some businesses, especially retail businesses. Now, the cost and time of due diligence by the lender to learn about your inventory can be demanding, and audits of these holdings occur every 3 to 6 months. The benefit, of course, is that you can accumulate inventory as your business grows to meet increased seasonal demand. In addition, the interest rates are usually lower than high-yield debt. And so let me provide a positive example with regards to inventory financing. So in a scenario where you recognize that right now we're in June, and in December I'm going to have a big holiday season, and I need as much inventory as I can. Now, I know that I'm at capacity for production, so I should be storing up inventory. But the thing is, if I begin to store up inventory, then I don't make any more sales, and therefore there's not enough cash coming into the business to pay for the working capital, for the bills, for all the costs of labor, for electricity, for my wage as well to support my own family. So what do? Well, I can take on inventory financing and delay the sale of that inventory and use the advance to pay my bills. And so once I get into the holiday season, I can then sell that inventory for probably more because it's in high demand market, pay back that line of credit, and realize a higher profit. So in that situation, if you really are confident that there's going to be strong demand later on, you can delay the sale of your inventory by using inventory financing. Now, there are several other challenges, and as you can see, there's more challenges than benefits to inventory financing, and that's why it's considered the last alternative. Now, interest rates are usually higher than bank debt. There are also tight restrictions on borrowing, and your business, the days inventory outstanding ratio, the amount of days that it takes to sell your inventory, needs to be small. So if you have a high ratio, what happens is that it takes longer and longer to sell that inventory, and therefore you really are stuck with inventory that is a huge risk, because if you can't sell that inventory, then you can't convert it into cash, and therefore you can't pay down that line of credit. So if the business has a high DIO ratio, then it's a significant risk. If sales fall due to weaker demand, all of a sudden the value of that inventory declines, and the interest charged on that loan can limit future production. So in a scenario where we can't offload that inventory and therefore pay down the line of credit, those high interest rates will really eat into our remaining working capital and the cash advance that we received on that line of credit. And therefore, we could be put into a position where we could go into default and risk default. So that's why there's a lot of risks. And if you take out inventory financing and the market goes against you, you can really get hurt, and your business can risk going into default. So I wanted to make a separate comment on just asset-based lending. When a company takes out a ABL, management is under the distant supervision of the lender, who continues to review the account receivable cycle of the business. In many ways, small businesses become more organized and focus on improving the management of working capital in the face of an ABL agreement. Their overall goal is to collect receivables and sell inventory faster to free up cash for future expenses and pay down the ABL from the business's perspective. This goal is reiterated by the lender. So really, the lender and business are working towards the same goal. The lender doesn't want you to default so that they take on that inventory, because if you default, the business probably defaulted because that inventory was not able to be sold, and therefore the lender would lose in that scenario. So both the lender and business are working towards a win-win situation, and most times for young businesses that have taken out their first business loan, an ABL can really help them mature as a company in order to manage their receivables better and understand the value of their inventory. Now, from the borrower perspective, there are three key ratios to consider when analyzing the borrower in order to understand their working capital management ability. We talked about the days inventory outstanding ratio, which is essentially calculated by taking the current asset of inventory, so inventory divided by cost of goods sold, times 365 days, which is the cycle of the accounting year. Now, two other ratios are the days sales outstanding ratio, which is essentially the amount of time it takes to convert all of your accounts receivable into cash. And so you divide the accounts receivable, the amount of accounts receivable in a calendar year or in a quarter, in that respective quarter, by the revenue in that quarter, or in this case, it'd be the annual accounts receivable divided by annual revenues to get 365. And for days payable outstanding, that is essentially the length of time it takes to pay outstanding accounts. So from the business, they might have accounts payable that they need to pay their suppliers. How long does it take for us to pay our suppliers? And so you divide accounts payable by COGS and multiply that by 365 days. Now, taking these three ratios, we then can use these three ratios to calculate the cash conversion cycle ratio, the CCC ratio, which helps determine the efficiency of the company's working capital strategy. So the CCC ratio is essentially the day sales outstanding ratio plus the days inventory outstanding ratio, so the amount that it takes us to convert our current assets less the amount it takes us to convert or to pay down our current liabilities. So DSO plus DIO minus the DPO. By calculating and comparing these ratios over the lifetime of the business, the lender is able to understand if the business is capable of managing its working capital and how risky it would be to lend them money. So the higher the CCC ratio is, the more inefficient the business is in managing its working capital. The lower it is, the quicker they are able to really convert on their current assets. So in conclusion, the ABL is a strategic alternative lending solution for small to medium-sized businesses who face working capital challenges. Whether they are highly leveraged or too small for larger lenders, i.e. the banks, these businesses have a financing gap that asset-based lenders target. While solutions like inventory financing can be costly, usually the cost of an ABL facility is cheaper than high-yield debt or mezzanine financing, and I've made a separate video on that. And one of the big things with them is that there are equity kickers in those mezzanine financing agreements, such as warrants, which compensate investors for that increased risk. Those equity kickers can dilute the existing shareholders of the business and therefore impact the amount of profit that you as the owner receive at the end of the year. So an ABL can be used strategically to actually benefit you in certain situations. Other than that, that's pretty much it for this video. If you have any questions, please like and subscribe to the channel for more, and please do comment below if you have any questions. Other than that, thank you so much guys for watching and have a great day. Thank you.